if there's no more questions, let's just kind of go into a slightly deeper dive on how portfolio planning works. So again, the way portfolio planning works is it's based on this concept of a portfolion. And a portfolion is like, you know, I named it after electrons and protons and portfolions. They're kind of the building block for portfolios. You can construct a very complex and a very sophisticated portfolio plan and optimize it by using these portfolions. And because you know the way it works is the portfolion is created and a portion of the contribution is put into the portfolion. It's invested for a fixed amount of time and then it's liquidated. Because it's a very simple portfolio, it's very easy to optimize that asset allocation. And what we're going to be looking at is we're going to choose an asset allocation that maximizes the goal for a given risk. And so we've kind of talked about that risk of shortfall and the projected income. And this is kind of the portfolio version of that. Generally what we found is most clients look for a risk of about 15%. That's kind of comparable to the 4% rule in some ways. It's sort of the starting point. And so what we look at is all of the asset allocations in the space that we can. We do this optimization algorithm. We look in all these dimensions, and we look all over the space trying to find the best optimal asset allocation so that the target return, the target end value of this portfolio will have the highest level of projected value given the risk of shortfall. So this is a little bit confusing because this is if you're not used to using risk of shortfall as a risk measurement, it's a little bit confusing. But this projected value here and the risk of shortfall are tied together. If you increase your risk of shortfall, and if you can tolerate a higher risk of shortfall, then your projected value at the end of the portfolio will go up. If you can't tolerate it, if you want a smaller risk of shortfall, then your goal will go down. Your projected level will go down. And so, in other words, what we do is we do a very conservative view of what the returns are going to be for this asset allocation. We find that asset allocation that will give us the best conservative view of returns. Does that make sense? This is a little bit complicated, and this in and of itself is probably worth a presentation. Does this make sense, Kim?
So and did that take into account too the time period? That if it's for 5 years versus 20-year time horizon.
Exactly. Yes. This will be very different. I'll show you on the next slide. You're kind of my perfect segue. I'll show this in the next slide that this is very dependent on how long this is invested and what your risk of shortfall is. So if you want to be very conservative, it's kind of like saying, okay, well, let's say we have an asset allocation. If we have a very low risk, we take a very pessimistic view of what our returns are going to be. If we want to be pretty aggressive, we're still pessimistic, but we're less pessimistic about what our returns are going to be. And we just try to find this asset allocation that gives us a best pessimistic return. Does that make sense? It's a little complicated, but once you've kind of played around with it a little bit, you'll kind of see that it makes sense. But if it doesn't make sense now, don't hesitate to ask me. If this is not making sense, what this risk is, how this risk plays into this asset allocation, let me know right now. Brandon, does this make sense to you?
Yeah, no, I'm not having any questions right now. I mean, it seems to all be making pretty good sense. Pretty easy to follow.
Okay, Kim, don't hesitate to ask if this is not perfectly clear. But I wanted to say that there's two things here. If you have a very specific goal, then you can kind of adjust these asset allocations to minimize your risk of shortfall and maximize the probability that your actual value will be above your goal and minimize the risk that the actual value will be below your goal. So there's two ways to do it. One is you fix the risk and try to maximize your goal, or you set a goal and try to minimize the risk and maximize the chance of surplus. So there's It's the same operation. You're just fixing one versus the other. Okay, so let's kind of look at these asset allocations. So if you're a conservative investor and you can only tolerate a 5% chance that your actual income will fall below the projected level, then for a 5-year investment, the portfolio is going to be mostly cash. And then the rest, the bulk of the remainder is going to be in intermediate term bonds, and then there's going to be a small chunk that's in stocks. And that stock portion is really there to kind of protect against inflation. So these are all optimized to beat inflation by as much as possible, if it's possible to beat it. Sometimes they don't project to beat inflation. But nonetheless, we're going to have this pretty conservative asset allocation. For 10 years out, there's a lot more bonds. Most of this, the vast majority, is intermediate term bonds, and the rest is in stocks, small cap and large cap. And then finally, at 50 years out, a very long-term investor, it's still majority in bonds. He's a very conservative investor, but he's got maybe, I don't know, 40% in stocks. So you can see that the time value is very important for this. And similarly, if you look at the 30% risk level, and I won't go into as much detail, but the 30% investor is much more aggressive. There's a lot more stocks. Even in the 5-year plan, they're in a majority of stocks. And then out at 50 years, it's almost, say, 90% stocks with a little bit of long-term bonds. And so it shifts them over to more of a long-term bond holding. And really, this person has a lot more stocks and a lot more long-term bonds. No long-term bonds over here at all. So you can see that these portfolios are optimized for the particular investor and for the particular amount of time that they're invested. And so if we look at this, we get all our asset allocations for each of these portfolios, and for each one of these, we get a projected return. And these returns are below the average returns. These are pessimistic returns. These are returns that there is in the case of the 5% investor, a 95% chance of exceeding these returns. Now, I made up these numbers. These are not anything, but a lot of times these early payouts, we project a loss on the earlier portfolios if it's over a short period of time, because inflation can just jump up and beat everything pretty easily. It's hard to protect it completely. So we do these asset allocations. We make a projected return of what the total return over this period is going to be, and we back calculate if we want a fixed income over this retirement period here. We back calculate, well, what are these portfolio initial values need to be? How big do these need to be? And that's how we determine this apportionment from this initial contribution. We back calculate these projections so that the end projected value, the conservative investment or conservative projection, is a level income. So does that make sense to everybody?
Yep.
Perfect. You guys are doing great. Okay, so like I said, there's my little dollars for each one of those things. Okay, now here's where the asset allocation changes with time. This is a non-traditional view of how asset allocation needs to be. So in this table here on the left, we have each column is a contribution, and it gets divided into portfolios, and each one of those portfolios is dedicated to 1 year of retirement. So these are the years of retirement over here in the rows. So for example, age 35 here, we have mostly long-term stocks, because at a young age, a 35-year-old, their shortest portfolio is going to be invested for 30 years. Their longest portfolio is going to be invested for 60 years, or maybe even 70 years if they're going out to 105, which they should be. So they might have, your average investment length could be 45 years here. So these are going to be mostly stocks. They're more aggressively invested in general, or they tend towards the stocks, depending on how conservative your investor are, but they tend to be the more aggressive thing. Now the next year, they're going to be investing for 29 years, not 30. They're going to be, this portfolio is going to be invested for 30 years and not 31 like the previous portfolio that was created, and so on and so forth. So these are going to be invested for a slightly less amount of time. So as the contributions go on, this one's going to be a little bit less stocks, a little bit more bonds, and so on and so forth. And then you can imagine here, just the year before you retire, some of your portfolios are only going to be invested for a year. They're probably going to be in a good chunk in cash. And then some of these other portfolios, they're still going to be invested for 30 years, but they're going to be more in stocks. But overall, this whole contribution is going to be more cash and more bonds. So that's the accumulation phase. Each of these columns represents the contributions and how their asset allocations get created. And that's why we see that the stocks decrease as they get towards retirement. As they age towards retirement, their portion of stocks decreases because they're contributing more and more into bonds as they get closer. And then there's a little tiny pinch, you can barely even see it, of cash. Now, what happens when they start withdrawing the money? Well, in their first year of withdrawals, they're going to be pulling this money out, and some of that money is going to be invested for 1 year, and some of it's going to be invested for 30 years. So this drawdown, the asset allocation, the things that's going to be pulled out of here, it's one of your shortest term drawdowns, because there are not very many, there are no other portfolios that are invested for 1 year. This is the shortest term portfolio, and this is 30 years. So the average here is about 15 years. The next year, it's 15 and a half years or maybe 16 years or something like that. So the average duration for these portfolios is 16 years. So there's going to be a little bit more stocks in what you're selling off in your second year, and so on and so forth. And by the end of your retirement, these things have been invested for at least 31 years, and some of these portfolios, some of that money is going to be invested for 60 years, have been invested for 60 years. So the average here is, what, 45 years old. And so as these time goes on, that explains why at the end of this, you're going to have mostly stocks, because these are long-term investments. You ought to keep your long-term investments in stocks and your short-term investments in bonds. And so there's this pyramidal or inverted V asset allocation. And it's non-standard, but this is how you optimize, and this is the appropriate way to optimize the asset allocation for an investor over their lifetime. Does this make sense?
Yeah.
Can you say which colors, which class is representing?
Yeah, you know, Sharon asked me to do that too. I don't know if I remember which is which, but these things that are increasing, so the blue is increasing here, that's a bond. I believe that may be intermediate term bond. The yellow is probably large cap stock, and the red is probably small cap stocks. And the blue, I can't remember. This may be long-term bonds. One of these is long-term bonds, and the other one is intermediate-term bonds. So sorry I don't have that on here. I should, but Sharon, in fact, Sharon said before this, hey, you ought to put those asset allocations on there. And there's a little tiny smidge of cash up there at the top. So it's hard to see, but you can kind of see here at the end, you have mostly long-term bonds and then stocks, and your intermediate-term bonds and your cash have been depleted earlier in the retirement. Any other questions, Kim?
No.
Okay. All right. So here's the summary. Portfolio planning provides significantly increased income, generally 2 times as much or more, oftentimes more, without giving up income longevity. It gives you a very precise optimization of the asset allocations and the withdrawals. And it really is suitable for the clients who want more money during retirement. Or that they want certainty that their money won't run out, or that they want to make sure that they have some money left over for inheritance. Some additional questions, some additional things here are, this is how you can get to the website if you want to try out. It's easy to you can www.portfolionplanning.com. You can there's a 30-day trial. You can go in and do your own plans and try it out. Take it for a system, take it for a test. One caveat here is that this is a little bit slow if you put in a 15-year-old, a plan for a 15-year-old who is going to retire at age 65 and who wants 50 years of income till they're 115. The number of portfolions that are in their portfolio, in their plan, is the number of years of accumulation times the number of years of retirement. And so a young 15-year-old, it might take you 10 minutes and to calculate it, and your browser could time out. So if you have a very young investment person, just be aware right now we have timeouts that occur. It's still calculating it. It's still working. If you go and grab a cup of coffee, come back 5 or 10 minutes later and do a refresh, your plan will be there, but your browser gets tired of waiting and it falls asleep and complains about it. But that's something that we've got on our agenda to focus on, is getting that the performance working correctly. We'll be at the ACP conference, so I think we're planning on doing an informal session there, and I hope that you'll see us. Are y'all going to the conference?
Yes.
Yep, I'll be there too. So that's awesome. That's right around the corner, right? And not 4 weeks away. Yeah. So good timing.
Yeah, exactly. So in the meantime, if you want to take it for a spin, there is, like I said, there's a free trial. You just need to put in your name and your address and email, and you can create a plan for anybody you like. You can give me a call if you have any questions, or email me, and I'd be happy to do it. Any questions or feedback? If you have any thoughts on it, I'd be really happy to know what your feedback is on it.
No big thoughts for me right now. Is there going to be what's called like a part 2 that kind of, like, I guess, a tool to learn how to use the system, the portfolio planning system? Or should I just go kick around myself and figure it all out?
Yeah, we can do. You know what we did on the first one? We had on the first one, what we did is we did a tutorial and kind of an overview of it, the case studies. And on the second one, we kind of did a deep dive into the statistical analysis, a lot deeper dive than I've done here. And what I did is I kind of simplified both of them. I tossed out the tutorial on how to do it and plugged in the statistics in a much shallower type of depth into this thing. So we've covered most everything, but I do have a presentation where I can just kind of cut out the walkthrough if that would help you. I could do that with you anytime, actually, if you want.
Yeah, I mean, I can go on, I think, maybe kind of explore and then see what I come across then that way.
Yeah, and you know, Brandon, if you have any kind of comments on what you come across or any kind of suggestions, I'd love to hear it. And Kim, what do you think? What are your thoughts on it?
I have a question. Like, say a client is contemplating what age they can retire at. So they, kind of want to get off the corporate treadmill, and they're, 60. They're like, can we retire now and have, we need at least, whatever, 50,000 of annual income. Can we retire, or say they're contemplating, can we retire in, say, 2 years or whatever at age 60 instead of working to age 65? Does it deliver you an answer as to what age you can retire at, or do you just kind of play with it and changing the retirement age to see, at what point you get to the necessary income level?
Yeah, it's all in the planning cycle here, and effectively what you do is we don't have a way of solving for the retirement date, but what we do is we'll give you a table of, hey, here's a possible retirement date next quarter, 2 quarters down, 3 quarters down, 4 quarters down, and so on and so forth. And so you'll see a table here, and it's easy for you to kind of look into it and say, oh, okay, well, you've got an income goal. You can change your date to 3 years ahead, and you'll still have your income goal. You'll still be able to meet what your income desires are. Or conversely, for the great many Americans, they may look at these plans and say, oh, well, you know, they'll look at the table and say, oh, I can't retire at 65. I need to retire at age 68 or so.
Okay. Okay. Good.
So, Kim, what do you think? Do you see any of your clients being able to use something like this that would be of value to any of your clients?
Possibly. I'm just getting started with one that's getting closer to retirement age. Yeah, it's really a different process. So I'm still kind of wrapping my head around it, but I want to go on and dink around and you know, really test drive it here and use the trial. But yeah, so it's a really interesting approach versus, like you said, how the more traditional ones are.
I lost my connection for a little bit, but I do want to warn everybody, if Jim hasn't already said this, that so the website itself is very functional. It can, on certain when you're doing certain things with the tool, it can take a little while to process. But if you just let it process, it will come back. It's not, you know, fading away or dying or something on you. You know, in our next incarnation of the tool, we plan to do some things to speed it up. But right now, that processing time does take a bit on certain steps, especially if you're planning for someone who's still in the accumulation phase, because it has to trudge through a lot more processing of the portfolios. There's just a lot more of them.
Yeah. Yeah, we covered that already. Yeah.
Sorry. Okay.
No worries, but thanks for the emphasis on that. Brandon, I'm kind of curious because it sounds like most of your clients would be not requiring something like this. So what do you think? Would it fit in with some of your other clients? Maybe some of the ones that don't quite have so much money, or where do you see this fitting in with your clients?
I think maybe for some of the clients more in the accumulation phase, just to kind of show them maybe, you know, in the future the numbers that they would, you know, have access to, right? In terms of this is kind of the range that you should expect to have in spending if you continue your current plan. Because I think everybody gets nervous, you know, how they're benchmarking against others and what will like you said earlier with the well, I'm forgetting the name right now. The
Money Guide Pro.
Yeah, Money Guide Pro and Monte Carlo. It's always like, oh, you're 60% equities and you're going to get 9% a year return, and it's like, well, it just always looked so rosy, I guess, so that we kind of like get very dismissive of those numbers and want something that, you know, just kind of give them a range, right, where they should be portfolio-wise and what they should expect in retirement without using, you know, just like the back of the envelope and things like that.
Right, exactly, and that's one of the things that's nice about this, in my view, is that you can adjust that conservative view. And you know, one thing that used to drive me crazy. So I did this in the '90s, and during the '90s, I would still see people saying, "Oh, well, the average return on stocks has been 12% a year, and you know, blah blah blah. You'll make, you know, at 12% per year." And I just was slapping my head, going, you should never plan. The chances of getting average returns is a flip of a coin. Your plan is going to fail based on a flip of a coin. Is that how, you know, you want your retirement to go? Is there's a flip of a coin and you'll run out of money? So that used to just drive me crazy, because that's a very high risk estimation. And they've gotten better now. And Monte Carlo is certainly a step in the right direction. But this allows you to really kind of adjust it. It's sort of like looking at the percentiles coming out of a Monte Carlo simulation. If you just looked at returns, if you were to simulate a single portfolio in Monte Carlo, you could kind of say, well, you know, what's the 5% percentile, or what's the, you know, very conservative view of what those returns are going to be. depending on how conservative your investor is. And if they're more conservative, you dial the knob and it makes it more conservative. But one thing that we found is that, unfortunately, for conservative investors and for long-term investors, Monte Carlo is just atrociously overly optimistic. You know, for somebody who's investing for 50 or 60 years, Monte Carlo gets it wrong in a big way.
Yeah, no, that's kind of my experience.
Well, the other thing,
you don't want to be so optimistic, right?
Okay, Brendan first. Go ahead, Brendan.
Oh, sorry. Yeah, you know, you give advice to people. You don't want to be overly optimistic, right? Like you said before. You know, hey, you're going to get 12% a year for the next 40 years, whatever. It's just use the numbers, you know, accurate.
Yeah. Well, and that's where we use the historical simulations because it's really important to drive home. We feel it's important just to make sure for our own comfort and for our own protection that the clients know that those shortfalls are real and that the risks, that they understand that there really is a risk of a shortfall. And if there is a shortfall, are they prepared to handle a shortfall? You know, have they been saving their 10% per year during a retirement? That alone gives them a 10% cushion. So if there's a 10% shortfall, it gives them a cushion. And but it also kind of makes them gives them a better understanding of the risk tolerance and how they need to adjust it. If they come back and say, hey, wow, I really can't handle that that low of an income, maybe I need to adjust my risk tolerance, or alternatively, maybe I need to save more, and hopefully, you know, they'll do some of both and save more. Okay, Sharon, go ahead.
What I was going to say before is, so I've used MoneyGuide Pro a little bit before, and one of the things that it does, and I don't know if anybody else knows, but for sure, but it's very deep within MoneyGuide Pro, there's a setting for your assumed interest rate. And I never could quite figure out exactly what they were using that for. And I think it defaults to 6%. And you can change it if you want, but I mean, it's really very deep within there. And so I even called them and tried to find out exactly what this was used for, and the help desk people were not able to tell me. But I think in hindsight, as I've looked at this stuff more and more, I think what they're doing is, I think that when someone is still accumulating, that they're calculating that lump sum portfolio by the time they plan to retire. And I think through that accumulation phase, that all their tool does is essentially a time value of money calculation or projection, where they're assuming 6% a year so that they get the size of that lump sum portfolio at the day of retirement. And then from there, they're doing the projections using Monte Carlo. And I'm not 100% on this, and I'm not trying to just keep, you know, bashing MoneyGuide Pro or anything, but I think that's how it works, which to me, if it does, is a little concerning. And I really tried to find this out from them one time, and I could never get a completely clear answer. So, I don't know. If anyone else ever figures it out, I'd be interested to know. But
yeah, I don't know enough, but that is a good question.
Yeah. Well, this kind of integrates all the nice thing about this also is you don't have to make any kind of assumptions as to what the returns are going to be or what inflation is going to be. All the calculations take into account inflation. All the returns are real returns. And so it kind of presents a standard or a constant standard of living.
So the returns are based on historical data covering the period back to 1926, is that right?
That is correct. And one of the things that is not presented in this presentation, but I presented it in the other presentation, is a more deep dive into those statistics. One of the things that you find is that the reason why Monte Carlo is inaccurate is because it does not take into account the error when you measure the mean return, the mean real return or the mean nominal return. And what I mean by error is that we don't really know what the true mean return is and the true standard deviation is for the stock market or the bond market or the market in general, any asset allocation. But all we know is a sample of the last 80 or 90 years. So it would be like taking a coin, and you don't really know whether it's a true coin, whether it's, what the probability of it coming up heads are. So you flip it 20 times. Well, if it comes up 13 times heads, well, that's 65% of the time. So does that mean that it's a 65% probability that it's heads? Well, you don't know, but you know that there's probably an error in your measurement there. Well, the same thing is true for the historical simulations. So that's why it's really critical to have as much data as possible. It minimizes the error for Monte Carlo and for our system as well, although we account for that error. That error creates uncertainty. It creates risk, because if the last 80 years were above average, above what the true mean is, which there's a 50% chance that our historical data is above average, but then you could be making these projections out for 50 years, 60 years, and with this assumption that all these historical returns are going to continue on in the future. And so you have to account for that uncertainty, and that's kind of why we go into this. It's a long discussion, it's a detailed discussion, but it's very important to have as much data as possible, and that's why we stick to these really plain Jane investments that we have data that goes back to 1926. Does that answer more than you really wanted to know, Kim?
No, because like you said, we don't really know. Right, if all of our data from 1926 to date is rosier than what will come in the next, 100 years, we don't really know how many sides on that coin.
Right.
It's not just heads and tails and easily calculated what the odds are. It's really unknown. We have historical data, but we don't know if that data is going to continue to hold true. So, so dialing down those expectations is certainly more in my comfort zone, because I tend to think returns going forward may well not be as rosy as they have been in the past. Right.
Yeah, we're considerably more conservative than Monte Carlo would be, especially for conservative investors and especially for long-term investors. Those are the two. That's the worst corner of this is a conservative investor who's, you look at their long-term projections, and really we're making 70-year plans for somebody who's 35. You're making a plan for 70 years, and you only have 80, 90 years of data. It's like one data set. We have one complete retirement plus another 20 years of our historical data. So it's not nearly as much data as you want. And what is really scary is a lot of these firms create these retirement plans out of funds, and actually the funds that have only been around for 10 or 15 years, and they're coming up with these asset allocations and these return projections from these things. And I'm thinking to myself, those return projections are not rigorously calculated. Their risk estimations are undoubtedly not sound. And what's worse is, there's a gazillion problems in there. But even if you're one of the things that's dangerous about it is that you could say, well, all my funds. Funny how it works out, but all my funds all were created and started in business just before the big bull market in the Reagan years. Or funny how just before all of my funds just started were all created just after the collapse in 1988 or whatever, right? So they what you end up, there's a risk that you can pick a time period that's really great. You can cherry pick a time period and say, well, we're going to use our statistical data, and it doesn't include 1970s. If it doesn't include 1970s, that's the worst, period in the history of the United States, investments. And the other thing, and this is something that I actually regret a little bit, but this concept also means that you really probably ought to stay away from international funds. It's how well did the Chinese stocks do? When the Japanese invaded? Well, they didn't have stocks. They didn't even have a stock market that I know of. And similarly, how well did Japanese stocks do when we bombed Hiroshima and Nagasaki? And when Japan surrendered? I mean, we completely decimated. Even if there was a stock market then, we certainly have no data on it. And so anyway, the S&P. My story on that is the S&P 500 does have a very substantial international portion in it already. Ford has a very large presence overseas. A lot of these companies, Walmart. You go down to Home Depot. You go down to Mexico, you'll see a Home Depot. You'll see a Walmart. So. Anyway, that's the one regret I have, that we really can't include international stocks in here.
Okay, so there's no allocation to pure international funds. It's just to play within the large corporations having international activity.
Yes. And let me see if I can pull up. I've actually got a chart that had the asset allocation there. Here it is. So these are the assets that get used. And one question on the last presentation was, well, okay, so we got the small caps and the S&P 500, long-term corporate, long-term government, intermediate-term government, and cash. Well, I mean, it's a very restricted set, but it still works pretty well. I mean, you can get pretty good pretty good income out of this basic. These are a pretty good sound base, but a lot of 401ks don't have long-term corporate funds, and they don't have, maybe not even intermediate-term government. Maybe they just have intermediate-term bond index, or maybe they don't even have maybe they just have a bond index. The answer that I gave to folks last week was that this is reasonably flat around the ideal. In most cases, when you're right around the ideal point for the asset allocation, you can vary this stuff reasonably. You're reasonably flexible on what you can do most of the time. I haven't done a complete exhaustive study about how tolerant you are and how far apart you can make these things, but for a lot of these portfolios, you throw in a general bond fund instead of the intermediate-term corporate. If you don't have long-term corps, well, throw in an intermediate-term bond with a pinch of stocks in it, because the long-term corporate funds tend to protect you against, inflation a little. They tend to have a better long-term return. So, I want to encourage you that if you don't be afraid to vary this a little bit. I don't want you to just go off the reservation and just completely redo their asset allocations. These are there for a reason. They're very precisely calculated, but the precision is not required. The ultimate, there's a little bit of play that you can mess around with, and you won't sacrifice things too much.
Yeah. What about the tilt towards the, been argued towards value?
Well,
French.
Yeah, I've heard that, and especially the small cap values, and there's that strategy there, and I don't have enough data. That the answer is, it could be true, it could not be true, but we don't have 90 years worth of data. If you go back for 20 years or 30 years and say, okay, well, for the last 20 or 30 years, value's really beaten growth. Yeah, that may be the right thing. I tend to not believe in value versus growth because too much. I personally am a value investor. I would, when I play in the stock market with stock picking, I do a very value play, but I'm not sure that value indices represent value very well, in my opinion. Sometimes value is a growth stock that's really cheaply priced. If you look at its earnings history, and it's consistency of earnings. Sometimes there are, Walgreens may be a growth stock, or a Walmart, or some of these other ones, but it's valued so reasonably. Sometimes these growth stocks can be value stocks, and so I'm less concerned about that because I'm not sure that division is the best way to divide the market, the way they define what value is.
Okay. All right.
Although, if DFA, I haven't really studied what they've got, but I would, at some point, I would like to get, because Ibbitson's, this all comes from Ibbitson's, and Ibbitson's so happens to be on the board of DFA, and it also so happens that their small cap, the funny thing happened is that the small cap index in the Ibbitson stock yearbook now represents DFA's microcap stock fund. So, the perfect match for this nowadays is their stock fund. Anyway, my point is, if those guys were to write some paper on the value versus growth and had some good historical data, I would probably look at it, or somebody, some other reputable person. But if they got to have long-term data.
Yeah, I think DFA I haven't really dived deeply into their materials. I did go to their conference, and I know they do stress the small cap and value direction, and that's been the basis of, SAMA's research. And so they have something they're basing it on. I can't cite you chapter and verse on it, though. But
yeah, I know that they're small. I know that they are certainly small cap advocates, and you'll notice that there is some nod to that, and that the small caps are the dark green, and they're significantly overweighted compared to large caps, I believe that they are right on the small cap being a better investment.
What's the best index you think for small cap?
Well, I personally just lean towards Vanguard, their small cap index, not because it's the best one, but because it's the one at hand. We don't use DFA in our practice, but if I had access to DFA and were to use DFA, I would probably consider their microcap fund, because I think their microcap fund actually more closely, well, for the last 20, I can't remember when they started using the microcaps in Ibbitson's data. So technically this really kind of follows their microcap fund for the last, let's say, 10 or 20 years. But I just use what's at hand because I don't want large fees. I think all of these assume, the other thing that we will be adding at some point in the future is that these assumed fees are zero, which if you were to invest in index funds, you're close enough that it's not going to be significantly different. But you add in your own fees, then you're significantly changing your outcomes. And if you invest in non-index funds with large fees, so above 0.25% or so, then we kind of, I've done the estimations where these are on average, if you averaged out, all of these fees, that they were about 0.15%, which is roughly the range that Vanguard averages out to. The difference is not significant. When you add in about 0.5% of fees to 1% of fees, then you have a significant effect on the outcomes. And I'll be adding that maybe, I'm not sure what the time schedule is on that, but that's certainly on, it's not a difficult thing to add, and that's something that I'm very interested in adding in so people understand what the effects of mutual fund fees are and of their own fees, frankly.
Great. Okay. Well, I don't think I have any more questions. I'm
All right,
Okay,
awesome.
great. Well, thanks so much, Jim and Sharon.
Well, thank you guys, and don't hesitate to call.
Okay,
right,
great. Thanks so much.
Bye-bye.
Bye.